See, get the invites out. Y'all listening to the blog, you can fast forward a couple minutes. We're just getting the invites, waiting for the live studio audience to come in. This is Stock Talk Live. This is Money Mark. This is the 30-year Wall Street veteran who Jim Cramer's funds paid for picks. George Soros paid for picks. And if you watch the movie Dumb Money, Stevie Cohen paid for picks. Let's see, where is our... I forget where it is. That's okay. We'll leave it like that. I'm going to double check to see if we got audio and video. The invite is out. Veterans, share the invite so we can get the show started. People on the blog, on the podcast, welcome. Feel me? Like it's we got just a new feature so you guys can listen in on the show for once on the replay. Let's see here. We got audio and video. Let's see. People on the blog. Yeah, we got audio, we got video, we got some people in the chat already. Share the live, veterans. Share the live. We got to get the numbers up to get started. I was on vacation last week. Still a little bit on vacation here today. Not kidding. This is actually just a liquid dinner. I haven't eaten in, I don't know how many hours now. It's got to be 9 hours. Working hard for the content going into this show. Is AI dead? Phew, some parts of it might be. Okay, and that's the important part. What stock should you buy? What stock should you stay away from? What's going on in AI in general? Did Kimi K2 just put a nail in the coffin of OpenAI and Anthropic? We're going to talk about all those things today. Just get people in the chat. I'm going to drink me some beer. I'm going to get you... we're going to get to the... let's see, where is it? Where's the disclaimers and disclosures page? I forgot where I put that. You guys got to help me out with some of these things sometimes. We got to get the disclaimers. Oh, you know what happened? I know what happened. Man, let's see. Presentations. I got to find the presentations. Slides. Latest presentations. Here we go. Brilliant. Brilliant, brilliant, brilliant. Okay, there we go. There's our slideshow, and there's our people. There's the numbers. That's what we were looking for. It took a few minutes for you veterans to get people in here, but you're in here now. You're in here now, and you know what it is for you at home, y'all on the replay, y'all on the podcast. It's Friday. It's Money Mark. It's Stock Talk Live. We got a big show, and we're 3 minutes late getting going here, folks. So we're going to get right into it. Here are my disclaimers on the page. You guys should read this, and if you cannot read, have somebody read it to you, and just know that you acknowledge, if you continue with this broadcast, that you are cool with what you see on this page, what you've heard from whoever read this page to you. I am not a financial advisor. I'm not your financial advisor. I'm here to provide you with research. You decide what you want to do with it. Okay? I'm not responsible for any of this. How about that? Much better than reading it off, right? Those of you at home, there's my X account, Money Mark Stocks. There are 3 things about me that are different from all the 10,000 clowns out there trying to give you their picks. Okay? 1, I give you my real name. It's out there. Why? Because number 2, you need to be able to look up a person's credentials. What makes them a professional in this industry? Okay? That's what you get here at pipelinedatallc.com. My old business website. I still keep it up and running because there's some cool stuff over there. And then a live real-time tracker of performance. Mine goes back to 2014 and shows 40% annualized returns going back to 2014. My first pick was Facebook way back then. Bottom ticked that stock just about many, many years ago. 3 things to help you newbies, because I'm going to talk about some things that you're not going to understand. It might go over your head because I'm not one of those 10,000 clowns. I am somebody that Jim Cramer's funds used for picks. And there is a method behind that that said, hey, we need to give money to Money Mark. All right. And if you want to understand this show, you want to check out, listen to this on my X account. It's pinned to the top of my X account. You want to read this. This is at markohmstocks.wordpress.com. Get rich on stocks. And then on this YouTube page, How I Make Money on Stocks, watch that. So listen, read, watch, 3 simple things, and that's it. That's the only catch to this whole thing. There are no sponsorships, no subscriptions, no nothing. I don't make money off of this doing anything. In fact, I swore off revenue in 2015. Haven't taken money for anything since then. The only income I have is the capital gains on my wealth. And I've been retired since 2008, so I don't even need more money. I've been all set since 2008. This is just my way of giving back because my mentor gave this to me. All right, enough of that before we bore people off the show. We got to get going here because did Kimmy just kill AI? Like, we have the DeepSeek moment, and now we're having the Kimmy moment. People talking about Kimmy K3 pushing Chinese AI into Fable level territory. For those who don't know, Fable is Anthropic's latest AI model, the one that, made all the noise about how it was going to break into every website around the world and the government shut it down and all that stuff. Yeah, that Fable. All right. Now we got Kimmy K3, which is a Chinese AI model coming out, and some people are saying it's as good as Fable. So how can we keep up with Chinese and open source and Chinese open source models? And what does that mean for all of us? Well, hold on. I'll tell you as soon as I have this sip of beer. So, number one, right? This is good news for the AI industry. Anytime you have more models coming out doing new things at a cheaper price, it's good news for most of the world. Okay? Now, it might be bad news for OpenAI. It might be bad news for Anthropic, both of whom would like to go public soon. Right? I'm going to tell you, I think Anthropic does go public this year. And I do think it goes with a high valuation. I do think they can get that $1 trillion+ valuation. Why? How, Mark? How is that possible? Models are worthless. Models are commoditized. Everybody has great models. If you can get an open source or a Chinese model at 1/10 of the cost of Anthropic, of Claude, of Fable, then what are those models worth? Listen. Don't listen to the 10,000 clowns out there, first of all, right? Not to mention the fact that we don't have to worry about it yet. Anthropic's not public. OpenAI is not public, all right? ChatGPT. OpenAI owns ChatGPT, or that's their product. You have to think about some things that go around the model. The model is not all there is to it. That's number one. Okay, there's orchestration, there's harnessing, there's security, there are vertical models. I'm not going to get into all that. It's too technical. It'll bore you all to death. But the fact remains, if somebody tells you that the commoditization at the model level is bad news for AI in general, is bad news for OpenAI and Anthropic, ask them about orchestration, harnessing, security, etc. First of all, okay? Those things are critical. The other thing is, a lot of these models, when they talk about an open source model can do things with 95% reliability. That's really close to the 99% reliability you get out of OpenAI and Anthropic and other models. Well, here's the problem with that. That sounds cool. Because when you're in school, if you got a 95 on a test and your buddy got 99, y'all both got A+, basically, right? That's not how it works in AI world. Because in a corporation, they are looking for what's called 5 nines reliability. 5 nines being 99.999. All right? If you get 95% reliability, that means 1 out of every 20 things that happens fails. What would happen if 1 out of every 20 of your invoices just disappeared into a black hole, right? There's a lot of things, what I'm trying to say, that these cheaper models cannot do. Now, what I will say for the bears is that all these models are commoditizing the low end. Okay? My mom wants to know why the sky is blue. What happened to Napoleon at Waterloo? Any model will handle that. She doesn't even need to pay for AI. She can use free AI and get the answer to those questions. Fine. So what we got out of ChatGPT a few years ago is basically worthless now. That doesn't kill OpenAI. But the reason I'm telling you that Anthropic will go public first is because OpenAI, ChatGPT, was primarily focused on the consumer. And that's where the pricing is very weak. Consumers, like my mom, only need the simple stuff like, why is the sky blue? Meanwhile, Anthropic smartly went after the enterprise, the corporations. And he got them on the reliability, the robustness, all the security, the harnessing, the orchestration, all that stuff. And yes, there are things that they're doing that maybe corporations don't like so much, but they'll work through all that. Okay? They're going to work through these things. And more importantly, we're going to see AI, as I've been telling you for 3 years now, and I know because it's my 3rd summer here in Moldova since I started telling you AI is not a bubble. Okay? We're going to keep seeing advancements. And that's what the bears don't seem to understand. Is when I started talking to you a few years ago about this, it was, why is the sky blue? Oh, cool, look, we're getting an answer to that question. And then I told you we're going to start seeing, you can get pictures. You can ask somebody, make a picture of a sky with a rainbow and a sun, and it made it. Okay. And then it made it better. And then it started making videos. And now you're starting to see movies. I told you 2 years ago that we would get an Avengers movie within 10 years. Guess what? We're already seeing like fan-created Avengers movies on YouTube. Fan-created, I know Star Wars. George Lucas said he's cool with fan-created videos, and they're blowing up on YouTube. There's some of these things that are really taking off. Some of these stories, I bet you, they're going to be taken off of YouTube and turned into movies. You see a lot of content already. There was already a movie, I forgot the name of it, that came right out of YouTube. It was a YouTube-based content that went feature film and did over 100 million in revenue. 100 million. Some kid created something on YouTube that became a $100 million cinema movie. This is the thing that people don't realize. And this is just 3 years into things. I said 10 years. We're getting it in 3. So get the F out of here, bears. Okay? What we're seeing now is justified in the stock market I'm talking about. And here's why. But it has nothing to do with the bears being right about what's going on. There is a mix of different things happening. One, there's that confusion factor. The commoditization of AI, right? But more importantly, it's the uproar going on in corporations, because corporations got their hands on the ability to do coding, to produce software using AI. All these things. AI agents, all of these things that AI can now do to help automate the corporation, and they went wild with it. And the AI companies weren't ready for that. They weren't ready for that much usage, and why that's important is that they weren't, and they still aren't, charging full price for the services. Okay, what they were doing was subsidizing, is the word, charging in some cases a lot less than what it costs them to serve the product. I ask a complex question, it gives me the answer. I pay $20 a month, but I'm getting $100 a month worth of what it costs to actually compute the answer to those questions. Why would they do that, Mark? Simple. Why does a crack dealer give a new person free crack? To get them hooked. And once they're hooked, they start coming back, and next thing you know, you've got all their money, you got all their possessions, they're giving you their watches, their everything they can find, anything they can get hands on for the next crack rock, and the crack dealer makes a mint off of that initial free crack that they gave out. Okay? So, that made AI look like it was going berserk. Corporations, everybody's using it. Oh, AI is great. This was just a few months ago. But then Anthropic, etc., they say, yo, whoa, you can't have that much crack for free. So they started to cut back on the subsidies. That's number one. Now, while the crack was free, corporations started saying, hey, we're going to have a contest to see who can use the most AI in their corporation. It's called token maxing. Well, what happens when you start charging for the crack? The corporations say, whoa, what happened to our AI bill? We were paying $10,000 a month. Now it's $100,000? Whoa, we don't have budget for that. And they have to step on the brakes. But that's only temporary. And I get it. You're going to say, that's bad news. Yeah, it's bad news. Temporarily. We're going 2 steps forward and 1 step back. That's what AI does. That's what anything does. 2 steps forward, 1 step back. So as the subsidies start going away and the token maxing starts going away, it makes it seem like AI is going downhill. But it's not. On an overall basis. It's like your stock that goes from 3 to 5 to 4 to 6 to 5 to 8. Right? Ultimately, it ends up at 10 and you've tripled your money. But it had those bumps along the way that challenge your conviction in that stock. AI is not a bubble. I'm saying it again. AI is not a bubble. Okay? We're just going through one of those bumps in the road. What's going to happen next? Simple. What's already continued to happen. The models were going to continue getting cheaper. Deflation is going to continue. You guys may not know this, but the cost of tokens has decreased like 90% over the last couple of years and will continue. That's what happens in technology. Things get cheaper. This laptop that I'm using to contact you through, the 2 phones I've got in front of me right now, do you know what those would have cost 20 years ago? 40 years ago? That's the deflation you see in technology, and it's going to continue. And so as the cost continues to drop naturally, it's going to catch up to the fact that the model, the hyperscalers, right, are reducing the subsidies. So we got something that's bringing prices down, even though the hyperscalers are raising prices up. But eventually you have this point where the higher prices are producing a great profit, and they can start lowering the prices again, because that's what technology does, is price deflation over time. Okay? And at the same time, all these models that are coming out that are commoditizing the low end of AI, what does that do? It just makes you be able to use AI more at a cheaper price. It's the same thing that happened with laptops and phones. Because even though remember that brick? If some of you are old enough to remember the brick, the cell phone that was just a giant brick, and only rich people had them. Right? Now everybody has a smartphone that's a zillion times more powerful than that brick was. That's what happens with technology. Okay? So we're going to see that happen. And yet, even though the price of an iPhone, relative to what an iPhone that has this much power 20 years ago has decreased, this is a $1,000 iPhone. This would have cost $50,000 20 years ago. So how is it that the same iPhone depreciates from $50,000 of value to $1,000 over the course of 20 years, right? In terms of the same power levels and stuff, which didn't exist back then, but right, just bear with me. And Apple still ends up being one of the most valuable companies on earth because the cost inputs come down too. People need to understand that this is just what technology does. Okay? Now, we are going to talk, that's not all winners. So we are going to talk about that on this show. But let's take a step back and get to the macro real quick. We'll get to the charts. We've got so much to talk about. I have actually 2 pages of notes plus all these tabs to go through and your Q&A. So by the way, FYI, those of you on the live broadcast, if you have a question, put 3 question marks in front of the question, right? I see some at the end of the question. That's cool. I see it. As long as I see something that says this is a question, because we get a lot of comments, and I love it because I don't charge for this. There's no sponsorships, no advertisements, no nothing. This doesn't lead to me asking you to sign up for something or anything like that. This is just free. So all I ask is that you let people know that there is somebody who is not one of the 10,000 clowns out here giving this service for free, and give me the thumbs up and give me the comments in the chat. That's all we ask for. So take care of that right now, and let's get to the macro. Here we go. Fear Greed Index. Neutral, 50. How? It doesn't feel like 50. It feels like 10. It feels like an absolute disaster out there. How is it possible that we are at 50? Well, that's simple. Because this is the entire market. This is the S&P 500. Not the entire market, but the S&P 500 sentiment index, okay? And the S&P 500 is not crashing like the AI stocks, like the Qs, right? Uh-oh. I wonder why this is happening. We'll do a wait. Hopefully this doesn't interrupt the broadcast, but we've had this thing going on here. And look, we zoom in on the Qs, and it's looked ugly. Okay, we are, as of this morning, when we had that big sell-off this morning, and I'm going to talk to you about what this is all about, what we're seeing today, 8%. 8% drawdown. That's almost a full correction, right? But of course, we've already been here because we had that over here. We're just testing, right? What happened this morning? We tested the low that we hit on June 9th. Bounced off of that low, bounced up, and now we're actually, if we really zoom in, you see what's happening today, right? Bouncing up and down, and actually the Qs are actually starting to pull back. This is actually also expiration day, options expiration. And somebody was talking about, are we going to get a 1987 event where the market just completely implodes on Monday? Listen, the 80s were different, number one. Number two, options expiration in 1987 before Black Monday was a triple witching event. This is not triple witching. That's number two. And number three, there has been so much put buying. The traders out there, the sharks out there that saw these stocks go through the roof. You had, look what Micron did. Straight up, right? And they saw the chinks in the armor. They saw the complaints. The corporations going, oh my God, our bill is too high. We need to pull back on AI. They bought puts. They bought puts. They bought puts. And when you buy puts, whoever sells you those puts, usually a dealer on Wall Street, right? They hedge because they don't have the put. They're short the put. So they short the stock to some extent to hedge the exposure they have to those puts. The more puts there are out there, the more shorting happens on the part of dealers. Now, of course, the reverse is true too. The more calls that are bought, the more the dealers buy stock to hedge against their exposure on the other side of the calls. But here's the problem. If you look at SMH, the semiconductor index, which is now down, as of this morning, 20% off of its highs, the put-call ratio is 3-to-1 going into today's expiration. 3 puts for every 1 call. That means there's a lot more dealers selling semiconductor stocks, the SMH, than buying, and that's created pressure. Now, what does that mean as we go into the end of the day? Listen, I'm not God to know, but those options are going to expire at the end of the day today. And so what will happen to some extent, this doesn't predict a rebound in the market, but all that call and put volume is going to flatten out because they were all going to expire at the end of day today. And then we start a whole new options month Monday. Okay? Which means that 3-to-1 put call ratio is out the window and we're on to an all new put call ratio for the future options expirations. So don't be surprised if at some point during this show the market turns around and starts ripping back up as we get closer to that expiration and the dealers look to flatten out their positions. All that shorting that they've done, right? They're going to know exactly how many of those shares they're going to need to call back for all the people that bought those puts. Everything's going to need to level out, in other words, okay? So keep that in mind for those of you who are spooked. Me, I've been a net buyer today. I've been buying a lot. We're going to talk about a lot of stocks. You're going to see some charts. It's not all rosy, right? Because look, I've been telling you, and somebody out there on X made a snarky remark. I'm cool with that. Snarky remarks are cool. Don't troll me. I'll block you. You'll be done. And then you've lost one of the rare characters out here that are giving you real research as opposed to the clowns. But as long as you're not trolling, I'll give you a response, right? And sometimes I'm wrong. Sometimes you're wrong. Sometimes you need an explanation. They asked, "Oh, do you hear that, Mark? That's the sound of the bubble bursting." And I said, what's wrong with you? Congratulations if your shorts are doing well, but I'm doing just fine. I'm probably within 1% of my all-time high. I set another all-time high last week. Why? Because the risk-reward methodology, how you take profits as stocks get to certain levels, and how I've been very, very conservative in this market, taking a lot of the money off the table, not putting it back into the market yet. Now I'm putting it back in. So I built up a ton of cash. I had a bunch of hedges, right? And yeah, IWM is usually what I short. RWM is usually what I buy. Those are my hedges. That's the Russell. But insofar as my portfolio has exposure to AI names on the NASDAQ, I short the NASDAQ. If you buy NASDAQ stocks, you should short the NASDAQ against them when you're concerned about the market rolling over. I've taught that. That's number one. Number two, the 50 and 200-day moving averages. Okay, we've crashed through the 50 in many cases. The Qs crashed through the 50. The SMH crashed through the 50. Micron crashed through the 50. So the next level of support for a lot of these things is the 200-day moving average. And for the NASDAQ, that's another 8% down from here, folks. Okay, so we have that risk out there. Even though if you look at the Russell, IWM, we're sitting right at the 50-day moving average. We haven't crossed down through that 50. Why? Because what I told you on the last show, it's a rotation going on. These institutions on Wall Street, most of them don't have the luxury of going into cash. They don't have the luxury of shorting stocks, putting on hedges. They can only shuffle money around. So when Micron got sky high, when SMH got sky high, what did they do? They couldn't go into cash, but they did sell. They did sell. Why? For two reasons. One, massive profits, but two, also allocation. Because when the SMH in 1 year goes up 300%, it becomes too big a percentage of those institutions' portfolios, whether they love SMH or not. And so they have to be prudent and cut back. And not for nothing, but about almost 100% return occurred just in the last 3 months. So that's a massive reshuffling that had to happen where they had to sell to bring the allocation back down. And what do they do with all that cash? They have to put it somewhere else. They can't just sit in cash. So it's been spread out. And so you see IWM, the Russell doing better, the S&P 500 doing fine, playing around with a 50-day moving average. Okay? That's how it works. And this is why you shouldn't, you can't panic in this situation, because if you follow the risk reward methodology, you were a seller of semiconductor stocks back here. Yes, you might still have some, and yes, you might be losing money. I lost a lot of money yesterday. I'm doing well today because of the hedges and some other things going on, right? You have to realize that these are the dynamics in the market that cause stocks to move the way they do, not AI is dead. That's bullshit. You know what I'm saying, okay? That is not the case. The fact of the matter is AI getting cheaper is great, not good, great for everyone and virtually every company on planet Earth, minus maybe Anthropic and OpenAI. And that remains to be seen, because the biggest money is not spent by the consumer on ChatGPT. It's spent by corporations spending millions on AI. And I told you on the last show, the companies spending the most on AI are seeing the greatest growth in earnings. So they're getting that ROI. Even though you've heard about the ROI decreasing, well, duh. When the crack dealer starts charging you for the crack, the net profit decreases. The net ROI decreases. But the ROI is still there and getting better all the time, because AI is getting more powerful and cheaper on an overall basis, even though it's getting more expensive right now, this month. And that's what causes this bump in the road in these stocks. So don't lose sight of that. All right, we got to talk about stocks before people get bored about this macro stuff. But that's it for the macro this week. Interest rates remain elevated, pretty close to 52-week highs. That's all I need to say about that. I've talked about Kimmy K3. Okay, just know that Kimmy K3 does not do a lot of things that Fable can do, and does not bring to the table a lot of things that Fable brings to the table for enterprises, and will not make anywhere near as much money as Fable will for Anthropic. And in fact, while we're at it, those who don't know why a lot of these open source models are coming out so much cheaper, the Chinese are making AI cheaper than they're stealing it, stupid. It's not that they're getting it cheaper, it's they're stealing it. That's not cheaper, that's theft. And you don't think that OpenAI and Anthropic, who have trillion-dollar valuations riding on this, aren't going to find a way to tamp that down? You don't think that the hyperscalers would stop spending money on CapEx if they realize that AI is dead? Who do you think knows more? Some dude with 342 followers on X or Google about how much money they should invest in technology? I don't know about you. I'm kind of betting on Google. All right, let's get to individual stocks. The last time I was here, I talked about Air, right? And how it had come back into the risk reward range. There it is right there. And I said, and I quote, 2 weeks ago, if you say, Mark, Air has pulled back a lot, I'm going to get back in, I won't call you crazy. That's exactly what I said. Go check the tape. It's on X, okay? The clip is out there. I didn't go say back up the truck on Air. I didn't do that. But I did say that I got out at 70. It ran to 110, but it came back down to 70. This was 3 months where the stock went nowhere, ultimately. Because the people that held on, if you had diamond hands at 70, Yeah, you went to 80 and 90 and 100 and 110, but you went right back down to 110 and 100 and 90 and 80 and 70 because you have those diamond hands. It's the rare skill person who knows exactly when to sell. If you sold at just the right time, congratulations. I'm not mad at it. That's what I'm here for, to help you make money. The thing that I need most in this world are more millionaire friends, people that don't have to go to work Monday through Friday, because guess what? It's boring to sit at home Monday through Friday, 9 to 5, watching Bob Barker. I don't do that anymore. I did that when I was a kid, but that was boring. Summer vacation was boring unless your friends were available to go play basketball. So I want you to be rich. So I am mad at it if you wrote it to 100 or 110 and got out at the right time. That's cool. But the risk reward methodology said too risky, above 70. So I sold calls. I got 76. And then the stock came all the way back to 62 3 months later. Do you know what my money, if I pulled, this is not the number, it's a much bigger number. If I pulled $100,000 out of air 3 months ago, and made 40%, because that's about what I made on my money over the next 3 months, 40%. On that 100,000, I now have $140,000. The person who just kept their money in air at 76, that $100,000 in air at 76, had a decrease of 14%. I went from 100 to 140. The other dude went from 100 to 86. I have nearly twice as much money as you now. And by the way, I can buy back into air at my discretion at that point. And I did. I sold some puts that got me some exposure, which obviously made some great money when the stock spiked. I got out because we're back above the red line again, right? And here we are back at what? $81. A mere $5 above where I sold originally back here under the risk reward methodology. So what now, Mark? That's what I'm here. I don't want to hear about you patting yourself on the back. Cool. Here's what I'm thinking. Okay? The price targets on Wall Street are now closer to 110. The news that we're getting out of air is stronger than I baked on. Right? When I drew these numbers up, when I drew these lines, and for those, if you are not one of the lazy people, wake up. You want to be a millionaire. Go read, listen, and watch those materials I talked about at the beginning of this broadcast. I'm not going to go back to that again for you veterans. You know what these red and green lines are for, and you know that I rarely move them. These lines have been here for years. Literally years, these lines have been in place. The red line I moved up somewhere around, was it somewhere around, I think around here, I moved the red line up. So it was 2023. We've been in this stock together since 2021. I moved the red line up at that point, and it's been sitting here ever since 2023. I'm thinking it might be time to raise this red line up again. Okay? Maybe something like that. Okay? So stay tuned on that. I'll leave it right there for now, just as a placeholder to show you. Right? That's what I'm interested in doing. I'll create a parallel line because I want to show, right, where it was and where it will be. But boom. So if you're still in air, I'm not mad at it. $80. Okay. Right? We see stronger progress than expected. We see Wall Street moving to $110 as their price targets, which means the institutions are going to be more willing to buy it at 80. Because 80 to 110... Hey Siri, what's 110 divided by 80? I know what the number is. 37.5%. Shut up. Don't even tell me. See, these phones are too slow. That's a 37.5% profit. Yes, thank you. 37.5. So institutions are attracted to that. That's a nice potential return. If we get halfway there, then they make 18%. It's beautiful. Okay? That's how the institutions think. I'm thinking I want to triple my money. Institutions are thinking I just want to make 15 or 20%, right? And they got the big money. They got more money than me, believe it or not. So, okay. So that's air. Great quarter, great backlog, great bookings. What else? There was one very important thing that came out of that call. And that is, and by the way, those just joining in right now, if you want to ask a question for Q&A, that's coming up in about 20 minutes. Put 3 question marks in front of your Q&A. The rest of you, feel free to put chat in the chat. Don't pimp your stocks in my chat. Don't troll me in your chat. I will block you from this channel immediately if you do either one of those 2 things. If you already have done one of those 2 things, go back and just delete your comment before I see it. Simple. All right. What came out of that call that's so important? Silicon carbide is back. I'm back, baby. I'm back, Mortimer. You old folks, you old head knows what that means. The rest of you can look it up using AI and then go watch the movie. Great movie. I'm back, Mortimer. Silicon carbide got smoked. And air got smoked too because of it. Okay? Because EVs, electric vehicles, right? EVs went gold mine. We got into air at 3. Air went to 53. And then EV started going downhill. And air started going downhill. And then AI came to save the day because silicon carbide is not only needed for EVs, but also AI. So when AI went gold mine, silicon carbide went gold mine for air, and air went gold mine. We got into air twice. We got in at 3. We got in at 7. Beautiful. Nothing better than 2 rides, right? But a funny thing happened. Even as AI sent air through the roof, leaving EVs in the dust, EVs started taking off again. Tesla had a great EV quarter. And so now EVs and AI are working together like chocolate and peanut butter. It's a delicious Reese's peanut butter cup of SiC, silicon carbide goodness. And all else being equal, there's a number of stocks. There's Wolfspeed, Wolf, onsemi, on CVD Systems, CVV, among others that are in the silicon carbide space that you can benefit from. Go do your research. Listen, man, I did all the research I could for 1 week, right? So for me to dive deep and get more into these names, you got to wait. Right? Because we're dealing with what happened this week, and I'm going to deal with the aftermath next week. So those of you who aren't lazy and got your pen out, right? If you got your notebook out and you're keeping track of all these ticker symbols and everything I say, you can do your research and find out, oh, maybe I should buy this one before Money Mark tells everybody else to. That kind of thing, right? So anyhow, silicon carbide is back. That's great news. So that takes care of that. What else we got here? Oh, by the way, and here's the more really important thing that a lot of people might not have thought of is that this was one of the first companies to give us a glimpse as to what's happening in AI right now. Okay? Everybody's been panicking on AI, and Air delivered a quarter that made their stock gap up. It was up 53% at one point. This is a multi-billion-dollar market cap company, went up 53% at one point after the earnings. You also have ASML, reported great earnings. Stock's still up there, not breaking the 50-day moving average like others. So what we're seeing out there is AI is doing great, confirming that AI is not a bubble. Okay? And I think that they are the reverse canaries in the coal mine, right? Because the canary in the coal mine usually dies. These are the companies giving us the advanced look at what we're going to see out of AI companies' earnings coming up in the coming weeks, right? In fact, it's already started. We're here in the middle of July. The June quarter ended June 30th. We're starting to see all those reports coming out now. I'm just going to put that on the screen. Right. Oh, by the way, they got another major order, $8 million of wafer pack orders. Right. Obviously, whoever bought those wafer packs bought them to expand their capacity. Well, they said it's their lead silicon carbide customer, and their lead silicon carbide customer is ON Semiconductor. So ON Semiconductor is expanding production. That's the simple read through, right? There's the Tesla information. Okay. Bunch of other stuff with regard to silicon carbide, what it's used for. Okay. And the uses are increasing all the time, just like the uses of AI. So I am bullish on silicon carbide in general. We're going to dive into individual names in the coming weeks. It's nice to see this because I told you a few weeks ago, right before Tesla announced their earnings, that silicon carbide is showing signs of life. And then Tesla reported and it showed real signs of life, and now we see more signs of life. So pay attention. Got your notebook out. This is how you make money. And there we go, more on silicon carbide on your screen. You can read that on your own in your due time. It is 2:46, so 46 minutes into this broadcast, you can see all this on the replay. ASML, we already talked about, right? So that was great. You can read that on your own. We're good there. Let's get back on a timing track so we can get to Q&A as soon as possible. Look at this. Look at this BS. This is Barron's, by the way. One of the 10,000 clowns. Yes, well-respected media corporation, just like CNBC. And you know what I think about them if you've been watching the show a long time. They're just trying to get clicks. How does Barron's make money? Advertising and subscriptions to the average person who doesn't know any better. Chinese rival to Micron could shake up the chip market. Do you not remember, if you have your notebooks out, do you remember me talking about a company called CXMT several weeks ago? Okay? I told you that this Chinese company, the government, is getting a request from Apple to be able to get their DRAM so that they don't have to pay the crazy prices that, well, first of all, it's not even, there's availability. It's the availability, not the price, more than anything else, right? If you can't get availability, if you're begging for DRAM to go into your phones, our iPhones are going to be $2,000 by Christmas. No joke. This could happen. Remember, I was the one that told you that DRAM prices were going through the roof back in like November when Micron was 100. Check the tape. The videos are all there. I don't delete them. Okay? And so here we are weeks later, and now Barron's is talking about CXMT rivaling Micron. Shut up. Shut up. CXMT cannot make the kind of high bandwidth memory that Samsung and HK Hynix do better than Micron, by the way, but Micron's the US darling, right? For some reason, because they're the ones that were listed in the US first. Now we got SK Hynix out there. SK Hynix is a better company than Micron, by the way, but Micron's in great shape. CXMT's in great shape, but they all serve different roles to certain different degrees. Okay? To me, Micron is number 3, to Samsung and SK Hynix, and CXMT is number 4. And they cannot do what number 1 and number 2 and number 3 do. But they can produce the DRAM that goes into our iPhones so they can help with the supply shortage that we have. They're not going to shake up the chip market. They're not going to rival Micron. Not anytime soon. Okay? Not this year, not next year, and maybe or even probably not 2028. We can hope because we want memory prices to come down. We want it. But it's going to be really hard because any LLM, large language model, right? So if you're thinking about Fable, Anthropic, when you use ChatGPT, those are large language models, right? ChatGPT is basically just the application that you use to communicate with OpenAI's LLM, large language model, okay? And so when you do that, that LLM is sitting somewhere in a data centers and all that. You need enough DRAM, enough high bandwidth memory to hold the whole model on it. That's the problem that we're dealing with, is that the whole model has to sit on the memory. Unlike your phone. You don't need 100% of everything on your phone to be sitting on your memory at all times. You got the cloud, you got apps that you open and close, things like that. Not so for the model. It needs to sit on the memory. It needs to fit on the memory. And remember the last time I was here, I was telling you, a lot of corporations don't trust their internal AI operations to a model that's out in the public. So what are they going to do? They're going to bring those models in-house. So instead of having one gigantic model sitting somewhere in a data center, you're going to have a bunch of them sitting all over corporations. And it's going to add up. They're going to be smaller models because the corporation may not need why is the sky blue. But if you add up how much memory is going to be needed to hold all of those models in duplicate, triplicate, multiple instances of the same model and multiple variations of all the other models out there, bro, I don't know how we're going to solve that problem. That's the biggest problem right now, and everybody knows it. So I'm not telling you anything new, but CXMT is not a rival to Micron right now. If anything, they're going to be kind of a savior. But maybe not to IBM. IBM got smoked. Worst day ever. Worst day ever for IBM. And IBM has been around a long time. My chart on IBM goes back to 1962. Before even I was born. Before most of y'all were born. I'm sorry for you old timers who were born before 62. Much respect. But then you know how great a company IBM has been over the years. And to say that this was their worst day ever, whoo, that's saying something. But guess what? They deserve it. They deserve it. They didn't go along. They didn't jump on AI, first of all, right? All these technology companies, Oracle, Google, Meta, Microsoft. I mean, IBM's name should be in there with the rest of them. You hear about all of them and what they're doing in AI, and it's big. They're all big in AI. What have you heard about IBM? Crickets. Crickets. And now that they're doing something in AI, what's it called? It's called Bob. How appropriate that IBM's foray into AI should be called Bob. These guys are bobbing for apples, okay? Head underwater, hoping for a bite. They're in big trouble for multiple reasons. One, they're not benefiting from AI as an AI player because they're really not. And number two, because AI is eating their lunch. One thing you guys, like IBM is known for their computers. What you may not know is while I was in the industry, they became a major software player. I remember the VP of software became a big heavy hitter in IBM because he put IBM on the software map. I wish I remember his name so I could gloat about it. Good guy. Steven. Oh, I forgot. So they got all this software, and a lot of it still runs on mainframes, that old equipment. And a long time ago, most of the people who know how to program mainframes retired. So it's kind of like a dead language. Oh, but it's not. Because you could teach AI mainframe language and it can produce mainframe language. And now all of a sudden, you don't need to pay IBM some massive hourly rate for the few old timers that know how to program in COBOL to go and help your corporation keep your mainframe applications running. They can now do it themselves or do it cheaper. Or some of these old timers can come out of retirement, use AI to augment their capability and make a lot of money. Cheap. IBM F'd themselves. Ultimately is the bottom line there. I won't spend any more time on that because I don't know how many of you really even care about IBM ultimately. What you should care about is the market multiple. Okay, the valuation of the market. And I've been showing you and telling you a long time, right? Yellow alert. Above the red line is a yellow alert or more, but we're not going more than yellow alert right now. There's no reason. I don't see an economic reason. I've only gone red alert twice in my career. That's how rare a red alert is. Twice in my career, and one orange alert. That was COVID. That should have been a red alert. But guess what? I'm not a doctor. If I had that expertise, I could tell you. But I did have the expertise to call the red alert for the internet bubble, and I did have the expertise in my corner for the real estate crash because I had a lot of contacts in that industry. I didn't have enough contacts in the medical profession to know how bad COVID was going to be. So that was just an orange alert. So that should tell you the magnitude of things, though, because an orange alert, COVID, that was bad, 30% down. Red alerts, multiple years of 40% down. Yellow alert, usually a yellow alert leads to a 10% correction on average. We've seen that happen time and time again. The last yellow alert did it. The last yellow alert did it. This yellow alert coming pretty close to a 10% correction here, and probably, I think at some point, maybe breaks down below the red line. But AI is the neutralizer, because if we go back to 1999, you'll see the market went way above the red line. Okay, so we had a yellow alert. It was a yellow alert right here back in 1998. Okay, December of 98. And then 99 ended up being the best year for the NASDAQ ever. And guess what? I was still long, 100% long, telling my customers stay long until November of 99. When we started to see the fundamentals turn over. And that's what we're not seeing right now. Until the fundamentals turn over, it's just a yellow alert. It was a yellow alert at the end of 98, but it didn't mean sell. And we are at a yellow alert now, but that doesn't mean sell either. Okay? So keep that in mind. And here's why. Here's why. Because AI is boosting earnings. Goldman Sachs came out with a report saying that 50% of the S&P total earnings growth, not total earnings, but earnings growth for this year and next year is going to be because of AI. Okay? Bottom line, we are currently trading, the S&P 500 is currently trading at 20 times next year's earnings. That's not a cheap multiple, right? But justified by this strong growth that we're seeing. Strong growth equals strong multiple. The problem is this. I've told you many times that even though AI is not a bubble, this is a build-out stage. Okay? And if this build-out stage, this initial build-out of AI infrastructure, it does not continue into the future once the build-out is done, right? Once the build-out is done, there's still going to be growth. If the growth doesn't match the build-out, then revenue growth is going to decrease, maybe significantly. And I do think that's going to happen. I don't know exactly when. Stay tuned. I'm keeping track of what's going on in the industry, right? But when that happens, earnings growth is also going to contract. In fact, maybe we go from 385 in 2027 to another 385 in 2028. Which will be fine, because without AI, we'd only go to 325. This $385 would only be 325 in 2027 without AI, which means if 2028 turned out to be 385, that would be great continuation of growth, but a smaller growth, less exciting growth, right? So instead, we've got this exciting growth that's occurred. We're going to do 385 next year. But what if we still only do 385 in 2028? The market multiple will contract. Maybe the PE goes to 15. Well, if we're trading at 20 times 2027 and 2028 gives us the same earnings but with a 15 PE instead of a 20 PE, that means the market tanks 25%, just like the PE tanks 25% on the same earnings. That's something to keep in mind. That's all I'm going to say about that, because I don't want to bore you. You can go back and listen to this again, let it sink in, ask AI, whatever. For those of you who understand it all, great. Let's keep going. Off the beaten path, before I go to the rest of my notes, let's finish off some of these tabs here. We had Electrovia with some electrifying announcement. These guys make batteries, very specialized batteries, by the way. right? It's lithium ion, it's normal batteries, but they make them with very good technology. They're very safe, reliable, and as a result, Amazon formed a relationship with Electrovaya. They've already been a customer, but they formed a formal relationship where Amazon said, we bought $21 million worth of your batteries next year. What if we promise to spend $285 million on your batteries over the course of the next several years? Would you give us a bunch of, let's say, warrants in your stock? Because we want to benefit from your stock going up. Well, that's what ended up happening. They made a deal. Electrovaya gave Amazon warrants, and the number of warrants equals 20% of the company. That's a big number, okay? And it will explain something here. For those of you who care about Electrovaya and wondering what the heck happened, where the stock went up as much as 55% on Wednesday on this Amazon news, and then collapsed 25% so far from that point. The reason is those warrants. If you add up the value of all those warrants, it cuts deep into that 285 million. Okay. Also, 40% of those warrants exercisable immediately. Amazon doesn't need to spend a dime. Okay. The other thing is there was no timetable. Okay. Amazon can keep spending $21 million a year like they have been. They don't have to change a thing. And over the course of the next 14 years, they'll spend their $285 million that they promised and get all their warrants with no extra benefit to Electrovaya. And so what happened was, after the initial excitement wore off, people who actually read the SEC filings realized, they had to give warrants. 40% of them exercise immediately. Not exercise, vest immediately. That was a miscue. They didn't exercise, they vested immediately. And Amazon doesn't have to buy $285 million worth of batteries next year, or the next 3 years for that matter. We don't like that as much. So you see the stock starting to settle in, starting to move down towards the warrant strike price, which I believe is around $8.85. So somewhere in this $9 range, okay, we get some normalization on the stock. Still a benefit over where it was, but still a far cry from its 52-week high of 13, which was not set on Wednesday, by the way. That was set already before. I think this is a good company. Okay, you need to keep an eye on the situation. I don't know exactly when you want to buy in. I have some exposure myself. Okay, but if the stock continues lower towards the warrant exercise price, or in the 880 range, I'm going to be a lot more interested right around that level. Basically for two reasons. One, this Amazon deal, I do think it's going to increase revenue over the $21 million per year. Two, they have 2 facilities now, not 1, but 2. The other one's going to get rolling very soon. But the first one is capable of doing about $100 million in revenue. And it's at like 80% of capacity. Now they're going to open that next facility, and they need to get that up to like 80% of capacity as quickly as possible. So this deal with Amazon helps to facilitate that, so they don't have a whole big facility making no money. And if you hear that dog barking in the background and it's driving you crazy, like it's driving me crazy, you will excuse me while I close the window. Oh, that's so much better. Doesn't solve the problem completely, but beer will. So keep your eyes open for that. The benefit here is the second facility will enable them to double revenue, double their capacity, more than double their capacity. I think capacity goes from about 100 million now to 210 million with the new facility. Amazon starts to fill that out pretty quickly, and Amazon becomes a lighthouse account. I believe that Walmart is buying product from Electrovaya, but I only believe because they haven't said it. Probably because they can't. Walmart doesn't just let people say, we're buying from Walmart. In fact, when they sign a contract, there's an NDA attached that says you can't tell people that we're buying from you or we'll stop buying from you. Okay? But they can tell people now Amazon's a customer. It's a big press release. And that can attract more customers to help fill that facility faster. So once the dust settles on this whole warrant issue, and it's going to create some waves. Like their next earnings release, they're going to have to explain, right, how this all works. Because when you swap revenue for warrants, it's tricky in terms of how you can recognize that revenue, what kind of expenses attached. Of course, it changes the share structure, the cap table, all that stuff. So it's a tricky situation, but one worth watching because I do think Electrovaya, from a DCF perspective, is worth much more than $8.34. It's just that there's a lot of things going on right now that may make the stock go lower before it goes higher. I'm not God to know, which is why I have some exposure now, right? But I don't have so much exposure that I can't build a lot more as I start to understand the situation better and if and when the stock price gets lower, because let's face it, money mark likes risk reward, and I would like to see more risk taken out of the stock for me to back up the truck on this thing, which I am not doing at this time. So stay tuned. Boom. One more thing here. We've got news that just came out today, just a few hours ago, where Toronto, the TTC, this is the Toronto Transit Authority. Okay. You know who's in Toronto? Our good friends, Gatekeeper. Okay. And there's the chart on Gatekeeper. And let me see here what we got. Pull up the information. Finally, the press release says, long overdue, a pilot program where these streetcars are going to catch drivers illegally passing those streetcars. Now, I've talked to you about this before. People getting off these streetcars can get killed. Kids getting killed. We don't want that, okay? And so what you're seeing is a trend. A lot of companies out there investigating, buying technology from companies like Gatekeeper to help protect the kids, okay? And so just today we have this press release that comes out, finally ramping up this pilot program, worth hundreds of thousands of dollars. Only 4 cars, it says. Okay, 4 cars. Do you know how many cars there are, street cars there are in Toronto? Take a guess, take a guess, take a guess. Don't take a guess in the chat. I'm going to give you the answer in a second. The answer is, where are my notes on this? I had my notes on this somewhere. Here we go. 235. Not 4, 235. Okay? So this could be, if this goes well, and I think Gatekeeper has put their best foot forward on this, this could be tremendous for them. And that goes in lockstep with everything I said. Nothing has changed since my June 15th article talking about what's going on at Gatekeeper, all the deals that I uncovered that haven't been announced. It's not illegal information. It's just, if you got to know where to look, because the deals they're winning are with, right, municipalities. Toronto, for example. They have to report. They have to announce. These municipalities have to announce deals. Gatekeeper doesn't. Okay? So there's a lot of deals that you don't get to see Gatekeeper announce because it's just not big enough for them to care. But what happens if you win so many deals that it adds up to a lot? That's what this report back on June 15th talked about. Okay? And if we zoom in on the chart, what you see is right around June 15th, we had a nice spike in the stock. It kept going, right? And then since then, what's been going on? The stock market's been going down, dragging everything down with it, including Gatekeeper. Everything technology, at least, right? So I'm not worried about this. We pulled back to this trend line support, and it's a loose trend line, right? You see here, I think that this drop off was unnatural. I think this spike up was unnatural. I think this is the true channel. So for me, this was like a buy opportunity here. I bought. I took some profits up here, bought. Hopefully we'll take profits at a higher level again. Okay. Now, there is some disturbing things going on out on the internet regarding Gatekeeper, though. It's not all roses. And that is, there was SEPTA, which is in fact, the biggest customer of Gatekeeper, the Philadelphia Transit Authority, awarded a deal to somebody that's not Gatekeeper. Uh-oh. No, stupid. That's not how it works. So there's people on the internet that Gatekeeper lost the deal. They lost the deal. They lost SEPTA. They lost their biggest customer. Shut up. Shut up. You need to do some research, clown. You 10,000 clowns out there who don't know how to do research, too lazy to do real research. Did Gatekeeper win the deal? No, they weren't supposed to win the deal. One of their resellers won the deal. Gatekeeper won the deal before the deal was announced because Gatekeeper is what is known as spec'd in. Okay? They are one of the specs of the deal. When SEPTA said, this is a deal, do you want to win it? Come make a bid. They said, here are the criteria, A, B, C, D, X, Y, Z. And somewhere in there, there was G, Gatekeeper. Whatever you bid on for this deal, whatever you use to satisfy this contract, one thing for sure, you have to use Gatekeeper's surveillance technology. Gatekeeper's cameras, Gatekeeper's software, that is part of this no matter what. So it didn't matter who won the deal, stupid, because no matter who won the deal, they have to use Gatekeeper. Mamma mia. This is what you're dealing with, folks. This is what's happening. This is why you don't want to pay attention to what's going on the internet, because how do you know which few of the 10,000 clowns, and it's like maybe 1%. So you have like a 1 in 100 chance of actually be dealing with somebody who's really knows what they're talking about and is really looking out for you. Like there's all kinds of rumors out there that Gavin Baker, who's brilliant by the way, like maybe the smartest former client of mine, Fidelity, technology analyst out there in semiconductor land. He's been pumping AI, but the rumor has it that he's gone on all these shows talking about how AI is great and all that, right? But at the same token, selling his AI stocks. Why do people think that? Because he's out there today saying, time to get back in. Well, when did you get out? Right? Brilliant man. But he's not an independent third party whose sole interest is in telling the truth about what's going on. His interest is in making his fund work, because that's what's going to make him a billionaire, not telling you the truth. And why do I tell you the truth? Like I said, I'm just giving back to society. And I get a benefit from it. There's obviously a benefit, right? Like if I find a stock that should be a 10 that's a 2, the faster everybody realizes that, the better. And you know what happens to my stocks, right? I go in at 60 cents, get out at 2, and that just keeps going to $6. This is what happens because I pick good stocks. For the most part, I'm not always right? But I'm here to help for 2 reasons. Because my mentor helped me, made my life what it is. I know what my life could have been. I know what my life was before, right? And I love hearing people. I get messages all the time. Mark, I made my first 100,000. Mark, I made my first 500,000. Mark, I made my first 1,000,000. Thank you. I love that. That feels great. Also, those people give me information about what's going on in their world. Right? There's people in the semiconductor industry that call me when something happens and says, Mark, here's what's going on in semiconductor world right now, which helps me make more money. Right? So all these things actually do benefit me. And that, I love that because it makes me feel like I can go to heaven. I feel like I'm not tempting karma. I'm generating positive karma by helping everybody win. I don't have to be the only person that wins. And it's such a great machine because you guys provide me with information. I distill that information and then give you information, and everybody makes money, right? There's a lot of people out there that only make money if they pump the stock. All right. So there's Gatekeeper. This is the presentation slide, so we'll put that way back here. That's good. There's the Gatekeeper update on my website, markohmstocks.wordpress.com. No sponsorships, no advertisements, no blah, blah, blah. There is advertisements on this site, by the way. I don't make any money off it. The advertisements pay for the subscription, right? So instead of me paying WordPress, they send you advertisements. I don't think that counts. If you think it does, then maybe I'll pay WordPress so you don't feel like I'm cheating somehow. But anyways, that was the news on Gatekeeper this morning that nobody saw because unless you were watching TorontoCityNews.ca, it wasn't a press release. Okay? This was, you'd have to, and it doesn't even say it doesn't say Gatekeeper here. But when I see news regarding the Toronto Transit Commission, I have to look because I know they're doing business with Gatekeeper. I want to know what the news is on the TTC because it probably involves Gatekeeper. And guess what? It did. So boom, there you go. All right. Let us, I don't know what chart to put on right now because we're not ready for Q&A yet. I've still got some notes. We're way late. We're very late. But I got to tell you these things. What do we got? Yeah, we'll put Gatekeeper up there. Why not? Since that's the stock of the moment. There we go. Put that chart up there. We could save that till next week. I told you about SpaceX. I was like, I didn't think that this was something you wanted to deal with. And boom, look at that. How's that for a chart? I mean, yeah, if you got in on the IPO and sold it immediately, that's great. But if you have diamond hands, you could have waited until now and bought at 125 instead of 135, or God forbid, the poor soul that bought in at 220. Okay? Valuation matters. Risk reward matters. Oh, it's cool to own SpaceX. He's going to own Mars. That's cool. You can own Mars. But it doesn't mean that your stock goes straight to Mars all at once. In case you guys forgot or didn't know in the first place, Amazon, back in the day, before it became a $250 stock, was a 29-cent stock. This is all split adjusted, by the way. Amazon came public back here in 1997 at 7 cents split adjusted, went to almost $6, and then all the way back down to 29 cents. If you jumped in anywhere along this way, you got smoked. Okay? The only people that made money in Amazon were the ones that got in the first 9 months. Anybody that got in over the next year and a half got smoked. And they didn't get their money back until, boom, somewhere around here after the financial crisis, where Amazon finally made a new all-time high. From 1999 until 2010, 11 years to make any money on Amazon. Do you know how much money I made from 1999 until 2010? Basically doubled my money every 2 years. And we're talking about 11 years. Enough said. Okay? You want to make millions, or do you want to make the same money that everybody else makes? That's how you become the 1%er. Do you want to be one of the 99%, or do you want to be one of the 1%? All right, let's keep going. That's SpaceX. I can save this for next week. I can save that for next week. We talked about that. We might be going to Q&A. I can save that for next week. Oh, let's eat some humble pie. How about that? Because I've been gloating so much, right? Patting myself on the back so much, I got a sore shoulder. It's not all roses, my friends. Look at that. What a horrible... I do not change what I said about TSSI. The parking lots were full, but the stock hasn't worked. Why? Not sure. It could just be because the market's gone down, right? Because if we zoom in on what's happened to TSSI in the last few weeks and pull up the the Qs have been going down since when? June 3rd. TSSI has been going down since when? May 29th, 4 days before June 3rd. Okay, so boom, we had a gap up here. It reversed the gap up and then started doing what the QQQs do, what the NASDAQ does, just with high beta. This is the thing. These are stocks that when the NASDAQ's going cuckoo, watch. TSSI will probably go cuckoo too, right? So, but the fact of the matter is, here's the thing. I bought a little too much of this. I didn't back up the truck, right? But what I saw was positive. I told you that it meant June was strong. June was definitely strong, and that gives us a leg up on Q2 having been strong. But there's two problems with that. One, and I told you about the first part, we didn't know how April and May went. But I was going to make the bet because of June. If April and May were okay and June was phenomenal, we have a great quarter. But here's the big thing. They haven't announced their quarter yet. Nobody knows how the quarter went. So between the time that you get the information that the parking lots are full and the time that they actually announce earnings that tell you the parking lots were full, and here are the earnings that go along with the full parking lot, people don't know that. I might be the only person that knows the parking lot was full aside from y'all, the audience. And so it's just a lesson. I shouldn't have bought as much. I should have saved some dry powder, and maybe even a lot of like traders will wait until the last day before earnings and buy the stock a few hours before earnings. All right. Just out of curiosity, I wonder at 322 if the Qs are starting to make a little turnaround. It's not. It's actually continuing lower as we head into options expiration. So very interesting action going on. But I think that's it. The rest of this stuff I can save for next week. So tune in because there is a lot of additional good stuff for us to add. The one thing I will say, let me see. Where is that? See, this is... I can't show you. I can't show you, but I can tell you. So Watt actually up 1.7% today. Why? Probably because it has just gone down, 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 down for weeks off of the 52-week high. It's off about 50%, and it hit its 200-day moving average today and bounced off of it. Okay? I've been telling you for weeks, right? This run up that we had into the 30s was, this is what I can't show you because I have to go into my computer and I might have to, I don't want you to see what's on my computer. We'll show it next week. I'll save this for next week, Watt data. I'll put that on here. The information that you guys have access to, if you follow the show and you're not lazy, then you know how many AWS deployments they have. Right? Part of what made the stock go cuckoo was the AWS deployments went from like 5 to like 10 to like 25 to like 50 quickly, rapidly ramped up to 50 deployments on AWS. Great news, right? Yes, great news. And that sent the stock soaring. But since that time, right around here, we saw the numbers level off around 60, and they haven't moved. For several weeks, the AWS deployments have been stuck at the same 60 level. Now, they've got a couple new POCs, proofs of concepts, neither one of which look as exciting as McDonald's or Amazon or AWS or Walmart. So there hasn't been anything exciting to get people to want to buy the stock. What I will tell you, though, is Watt, just as a reminder, at 15 and a half bucks a share, they got about 6.5 in cash. So you're only paying really $9 for the actual company, and that's about 50 million bucks. right? There are those out there that believe that the IP alone, intellectual property, patents and stuff, is worth $100 million. $100 million is $18. $6.50 is $6.50. That gets you to $24.50 is roughly what we might be looking at as a nice equilibrium point for the stock as far as value, right? In an environment where you don't see so much action on the execution side. So I'm a little concerned with what they are going to report in their Q2 results because things have been kind of quiet on the deployment side the last several weeks. Okay, but we've had a big pullback to the 200-day moving average, which might, gives us a little bit more value. You can see we went from the high end of the risk reward range. Those of you who learn your lessons know that these risk reward lines, these are king. It doesn't matter what's happening in a company. These lines are pretty much king. Gravitational pull for these stocks. And sure enough, as we got closer to the high end of the risk reward range, gravity pulled it back towards, because the fundamentals just haven't been strong the last few weeks, the lower end of the range. But now we're on the lower end of the range, starts to look attractive again. Okay, let's go to Q&A. We'll have more on that next week, as well as a bunch of other things that I didn't have time to talk to you about. So that's great. We're going to have a lot more, and maybe a new pick. Maybe a new pick. Yep. Let's go to Q&A. Looking for the triple question marks. Thank you for the comments. Thank you for the thumbs ups. Everybody give me the thumbs ups. Everybody give me a comment. That helps the algorithm, of course. First question in the queue. Saw you tweeted you own Anthropic. Is that via ZM or a different method? I don't talk about my private life. Okay? I own shares of Anthropic. That's it. It's not a public company, so you know that I don't own it through the stock market, but I'm not going to answer that question just because I don't want to make it a habit. It's not like I'm hiding something, obviously, but I do have exposure to Anthropic, and I'm just not going to answer that question so I can set the example. I don't answer questions that are private, about my private life. By the way, yeah, Kozla, bro, good beer, definitely a good beer. All, I don't know, 24 ounces. This is like standard size beer in Moldova. Joking. There are so many stocks in the buy zone. How do you decide between averaging down in something you already own or buying a bit of everything else? I don't think about averaging down. I don't like averaging down does not exist in my vocabulary. Okay? I look at the chart, right? And in the case of Gatekeeper, what do we have? It got to the red line, too expensive. Take your profits. Because I got in, at 30 cents? It was a 7-bagger. Okay? Your $1 million becomes $7 million. Take $6 million off the table and you still own $1 million of the stock. Except you got $6 million in your pocket now. Then the stock pulls back and you could take some of that $6 million out of your pocket and start buying stock. Where do you do that? You guys know right here at the 200-day moving average, I started buying the shares back publicly. Big mistake. But not really. Big deal. To me, who cares? It was already about halfway down the risk reward channel, hit the 200-day moving average. I like the fundamentals, right? Things were going well. So I buy some shares back on top of the shares I already owned. It breaks through the 200. Okay, that didn't work, right? And for technical analysts, they might sell the stock. It's a stop loss. I took a shot at it. The trade didn't work. I'm getting out. No, I don't get out. I wait for the next support level. And here it was down here, right? I don't wait for it to exactly hit the number because I'm not God to know exactly where this line should go. Buy more here. That worked out great, right? That was a, 55% move. Beautiful. So I get a 7-bagger, boom, and then I make the wrong move and lose 37% on those shares, but then I make the right move and make 57% on those shares. 7-bagger minus 37 plus 57 equals a lot of money. Cha-ching, right? Then you take some profits maybe because we've got this resistance here, the 200-day moving average, take some profits off of that. It pulls right back down to the trend line again. Boom, get back in, cha-ching. Pulls back down to the trend line again, keep going. And this is the great thing. I can make these trades and not worry about a stop loss, because if the trade doesn't work, it becomes part of my long-term position. I'm not averaging down. I'm being opportunistic in the stock based on the risk-reward rules that I teach. Period. All right. You mentioned AI phones in the future on Real 5G, knowing that you are looking at any radio suppliers linking Real 5G to AI phones. Yeah, you know what? There was, who was it? There was a stock. I'm going to write it down for next week. I haven't had a chance to really look at it, but 5G, I think filters maybe they make, and other plays. Okay. You know, my favorite 5G play right now is Radcom, up 2.6%. Very nice today. And you see that consolidation pattern going, right? We've had a nice move up, and then a move down, and a move up. It's forming that little wedge. You see that's the kind of wedge formation that you see. That's bullish. Wedge formations after a move up are bullish. It usually means the stock breaks out to the upside on those wedge formations. Okay, so that's nice to see. And not for nothing, but the stock is still nowhere near its 52-week high, $17. Right? We're off. We're getting a discount of what, 17% from what I still consider to be a bargain price. Right? If you don't own any shares, $16.70 would be a great price to own some shares. Right? But you get them at $13.90. That doesn't mean that I'm not taking profits. If I buy some shares at 11 and they jump to 15, I'll sell those $11 shares for 15. But the shares, if I bought shares at 15, I'm not selling those shares at 14, 13, 12, 11, or back here at $13.90. I'm only selling the shares that I bought at 11 because we got a nice move from 11 to 15. That's a 36% return. See how that works? All right. So boom, here we go. That's my 5G play right now, but stay tuned. I'll see if I can find more, because yes, AI is going to be running heavily on 5G, and 5G investments are going through the roof. I showed you some other 5G names. These names I didn't mention as part of the question because they've already gone cuckoo. NetScout, look at that. There's NetScout, Viavi, right? Through the roof, giving us a little pullback. This becomes interesting. Getting close to the 200-day moving average. Maybe Money Mark wants to buy a little Viavi here, right? Not backing up the truck, but, right? I'm positive on 5G. We've got an opportunity pretty close to the 200-day moving average. You saw what happened with Akamai here, right? Was able to make some profits at the 200-day moving average and close to it. Boom. These are the sorts of things, these kind of moves you can make. You don't need to be a special technician, right? All you need are the risk-reward lines and pay a little bit of attention to the 50 and 200-day moving averages. Anybody can learn these things, okay? Somebody wants the InfuSystems chart. I'm bullish on InfuSystems. All things being equal. I have some exposure to InfuSystems, all things being equal. It's at the bottom of this wedge, all things being equal. Do I expect it to bounce up to the resistance level at 11? Yes, I do. Do I expect it at some point to break above the resistance level at 11? Yes, I do. I don't know when that'll happen. I don't know if it'll happen. It could break down. Who knows? This is the thing, though, is when you're buying a stock at a good valuation, it doesn't matter. If it goes down, it just becomes part of your long-term portfolio, and then you've got your other trading money off to the side. The trades become investments. I'm sure you're going to tell us today, only if you know of news on Energus. Yeah. That's not a question. Don't be tricky like that. And like I said already, everybody has access to the same information I do, for the most part, right? I talk to management, I have other contacts, but that information that's out there, people from our community that made that website that shows you how many AWS deployments they have, how many proofs of concepts they have, you have that same access to information as I do. Except I'm really busy, so you might be able to get that information before I do. Your fear and greed is showing 38. Okay, a couple people said 38 for fear and greed. Let's double check. That's true. It hadn't updated. It's only 37 right now. Fear is dry. But 37 is still not all that fearful, right? We're not even paying attention to this chart at all unless it gets above 75 or below 25. Everything in between to me is just noise. All right, but thank you. By the way, thank you. This is what doers do, right? You double check your information. You actually check. Thank you. You are the ones that are going to become millionaires. You are the guys that are going to become millionaires and the ladies that are going to become millionaires because you're actually paying attention. Thank you. It feels like fear and greed should be less than 25 and VIX should be 20 plus. Well, if we had fear and greed for the NASDAQ, I'm pretty sure that fear and greed would be under 25 for the NASDAQ right now. Okay? So I am buying stocks. I actually played around this morning, right? This morning, I actually covered some of my short on QQQ, and then I re-put those shares on. So my QQQ position, my QQQ short is still as big as it was at the beginning of the day, but I made a trade in between where I covered my short a little bit and then put the short back on, made a little bit of money on that. Yeah, I'm just playing around. But yes, all else being equal, I am buying individual stocks because I do think the panic is getting overblown a bit, but I'm not rushing to some of these names like, okay, maybe I buy some AAOI, right? You've got names that haven't pulled back to the 200-day moving average yet. Like Wolf. I own some Wolf. Oh, it's pulled back to the 200-day moving average. Okay, cool. So I can buy more of Wolf. On semi, here we go. On semi hasn't pulled back to the 200 yet. So I'm leaving it alone. It crashed through the 50. And maybe it gets down to the 200. I own some on because of what Air gave us. On bought equipment from Air. On is increasing the capacity. That's bullish for On. But technically speaking, all the traders out there, the 10,000 clowns out there, aren't going to, right? They may not want to buy until the stock gets down a little bit more than 200-day moving average. So I don't back up the truck, although I have exposure because the fundamentals are good and it's pulled back. It's in the middle of my, right, range here. It's just that there might be a pullback to the 200. Might be. Sometimes it doesn't happen. You see, Akamai jumped 20%. Didn't get all the way back down to 200. Thankfully, your buddy Money Mark bought some Akamai on the way down, not waiting all the way to the 200, knowing that it might not go all the way to the 200. You want to, as you get like halfway down between the 50 and the 200, you want to buy some and then save some dry powder in case it gets all the way back. So if the stock rebounds, you at least make some money. And I did, right? Bought some here. I think I said it on the show maybe 2 weeks ago, the last show. And then it bounced to here. We can zoom in a bit, right? Buy in, get the bounce. Oh, no, that's not it. Oh, there we go. There's the bounce. And then you take the profits on that and then take that ride back down and get back in again. This is how you trade if you want to trade. I don't encourage it for you newbies. Just use regular risk reward, but this is how you trade. How big a problem is the lawsuit against Wolf? I'm not worried about it. Let's see. OPTX chart. What did your buddy tell you? Right? I told you it is worth closer to 12 than 6. And we got to ride it from 6 to 12 to 6 to 12 roughly, right? You bought it at 6, it went to 9. It got up to 12, so we pulled back from 9 down to 6 again, really 5, jumped up to 12, bounced back down to 6, actually got way above 12. I had nothing to do with the stock at this point, right? Because it was way too high for my taste. Now we're at 750 and getting close to that 200-day moving average. Getting interesting, and maybe the technical line is here. Not where it was. Technical lines can move very easily. So OPTX looks interesting here. See how more and more stocks are looking interesting now? Hey, Mark, after closing IDN a while ago, you said you would revisit later date. Is that something fundamentally changed? Yeah, I think I might have some IDN right now. In fact, I'm pretty sure I do. Let me see. Um, I don't volunteer these answers. If you ask me, do you own IDN? I am volunteering this, especially because it wasn't asked. I own a little IDN. I've bought back some IDN at these levels. We got out, what was it, 6, 7, almost $7? I don't have the chart up. So we did great. People were laughing at me when the stock got up to $8, $9. They're not laughing now. If you had diamond hands and you didn't sell when Mark got out at 667, I think it was, and it went to 7 and 8 and 9, you were laughing at Money Mark with your diamond hands, but now what? You're crying because it's 376. This is a good price. This is a good price. Money Mark is going to, right now, buy a little bit more. Right? Let's go in. Boom. Buy a little bit more. Not much. There's a lot of time. I'll buy stocks 1,000 shares at a time. And I'll buy 100 times or 200 times. Slowly get my way into a stock. As it becomes more and more attractive. I think they're doing all right. I think the company's doing okay. The stock's done horribly, and I do think that is worthy of owning some shares. So I'm gonna buy some shares. Will I put it back in the spreadsheet? I don't know. Don't ask me that. Right? You know better than ask me that. Let's see what we got. Next question. Yeah, hit that like button, people. Thank you. Thank you. This will save for next week as well. All right, good. I didn't miss anything. All right, all we got left is Q&A. And we're going to go into the lightning round in about 3 minutes or so. So let's see how fast we can get through these questions so we can give some good answers. Is it time to sell some puts now? I mean, what are we talking about? Have you not learned the lessons? Selling puts is kind of the same as buying stock. I say it over and over again. If you've had your notebooks out the last 3 years, you know that one of my favorite ways to get exposed to a stock, in fact, while I'm at it, right, I'll look at IDN. I can go into the options, right? I bought some stock, but I might also go into the options and say, all right, let's look at we got options expiration. So July is going to be done after today. IDN, we got the 4 puts selling for 45 cents. So that would force me to buy the stock for $3.55. I can buy the stock now for $3.72. So I'm not interested in selling those puts because they're not jumping out at me as being super attractive. Okay? But if they were, that's what I would do. I would sell the puts instead of buying the stock or do a combination of the two. Yes. Of course, when stocks look attractive, you either sell puts or you buy stock. I don't like buying calls, and you guys should know why, right? You have a time limit, you're paying a premium, and your timing has to be right. The stock has to go up quickly. How many cylinders is TPC has? I told you before, I'm not going to do the how many cylinders game for the most part. But they gave us some great results. And the stock is giving us a nice pullback. Look at that. Look at that nice pullback. Boom. To the 200-day moving average just about. Okay? Great price. Great entry price here for TPCS. I think they are going to move towards either operating on all cylinders eventually. They're finally making progress towards that, or get acquired by somebody who can make it run on all 10 cylinders. Would a pre-revenue company qualify as a priority idea under the rules even if the tech is approved by a third-party industry expert? You might be fishing to find out what my next pick is. So, suffice it to say, I'm not going to address the question from that standpoint if that's what you're trying to get at. But I'm not afraid of buying into any company if it checks the boxes. All right. It has to check the boxes. And yes, an independent third-party industry expert validating the technology is one of the major check boxes. And you have to know what an independent third-party industry expert is. It's not an analyst from Goldman Sachs, and it's not somebody on X, probably. It's somebody who's been working in the industry for, let's say, 30 years. So you have like a Dr. Castellano, who worked in the semiconductor industry for decades. He's an expert because he worked in semiconductors. I never worked in semiconductors. I never worked for any I didn't sweep floors for a semiconductor company. Ever. I'm not an expert on semiconductors. I'm an expert on analyzing semiconductor stocks, and that's only if I have an independent guy like Castellano to tell me the difference between a winning product and a losing product. Once I have that, like the report that we did, we got a $5,000 report on air from an independent industry expert who told us that they had the best technology back here when the stock was at 3. And then I did the math on how many of these air machines are going to be needed to satisfy the EV demand. And that's why we had a multi-bagger, a combination of independent third parties and my expertise. Thanks for everything I learned from my mentor, not colleges, which are ripoffs, not CNBC, which is a ripoff. And certainly not one of the 10,000 clowns. Thank you for all the comments. Right? Aloha. Yeah. Do you feel safe investing in SK Hynix given? No. Not necessarily. I don't like the big companies. I don't love the big companies, right? Let me see. Where is it? SK Hynix. I forgot the ticker symbol. There it is. Sky High. SKHI. I want to wait. I don't have any frame of reference here. I need a South Korean chart. I need all that. I'd rather play with Moo, right? And I'm not really ready to do that yet, although it is very tempting. All right. Pretty soon, if we get a little bit more of a drawdown, I'm going to be interested in getting some shares of Moo, even though it's such a mega cap stock. That's the thing. Listen, you're not going to triple your money on Micron as fast as you might triple your money on a Radcom or a TPCS. And it's simple because they're so big. You're not going to triple your money on Google anytime soon. I'm sorry, that's not how it works. Yes, you're going to get more safety. Google is a safer stock than Radcom or TPCS. But that's why you make more money with the smaller ones. You eliminate the risk, or you reduce that risk differential, right? Google is safe. You figure out that Radcom is safe by doing research. And I researched so many companies, and company number 1, let me research it. I cannot eliminate the risk. I cannot eliminate the concern that this is a safe company. I cannot say this company is safe. Company number 2, let me look at it. I cannot prove that this company is safe. Company number 3, this company looks safe. I check all the boxes. The third-party industry experts say that they're the best in the industry. The industry has some tailwinds behind it. Their finances are good. Their balance sheet is good. Their capital structure is good. Everything's good. Check, 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 check. The risk-reward chart looks good. The stock is low in the risk-reward chart. The technicals look good. Check, 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 check. That name can be safer than a Google if you do the research, because the competition to research a Radcom or a TPCS is infinitely lower than the research against a Google, because there's literally hundreds of Wall Street MBAs looking at Google. How are you going to beat them? You're not. Okay, lightning round. Here we go. Do you consider Chartorama charts to be 10s? No. No. The Chartorama charts, what? Are you crazy? No. Chartorama is just Chartorama. It's just me showing you charts so you can, have something to look at. It's just eye candy while I'm talking so you don't fall asleep. Okay? These are names that I'm interested in. That's all it is. Just because I'm interested in the name doesn't mean they're a 10 or a 5 or a 1 or nothing. Have you bought AVEX again? I don't answer personal questions. Old fart, salute, bro. Steve Hoff. How's the beer over there? Great. Don't ask me questions like that, though. I'm glad it was quick, though. I'll make an exception, and I'll have some beer. Isaiah chart. Look at that. Beautiful. Perfect time to be buying some Isaiah. So you see what I'm saying? You see what I'm saying? Like, the market, I don't have to worry about when's the market going to stop going down? It doesn't matter to me because I'm here in an Easter egg hunt looking for Easter eggs. And a stock that I like that was up here and came back down here is an Easter egg that I want to buy at these levels. And you see, the stock is up today, probably because some of you A students know that you want to be buying IZ at these levels, that you want to be buying Radcom at these levels, that you want to be buying Gatekeeper at these levels. You're the ones making money, you A students, you homework doing A students, making money, becoming millionaires, and the rest of you clowns out there, joking. If you want to be an A student, if you want to be a millionaire, you will do what it takes. You will listen, read, and watch my educational materials, which don't do nothing for me. I get no benefit from you listening to this. I get no benefit from you reading this. I get no benefit from you watching this, except for you becoming a member of the community that might contribute back at some point. Lightning round. Oh, that's Isaiah. Intermap. Still waiting for the Indonesian deal. The Indonesian deal is in wait time. The company is not in wait time. It is in gold mine and approaching the green line. The reason the stock come back so much is that Indonesia means so much to the company. Indonesia is a big part of the reason why there was a potential for the stock to move up to $4 a share. And that thing has been like infinitely delayed. So until the news comes out on that, the stock just drifts lower because that major aspect of this company is in wait time. Not the company as a whole, but something that represents a huge chunk of the company is in wait time, and that creates this situation. It's like a big rough patch. It's a giant boulder of a rough patch as opposed to pebbles and rocks that most companies go through. A lot of companies go through rough patches, but not like this one. Put it down in your notebook so you learn. Because I haven't been heavy into Intermap for a long time. I took a big profit on Intermap a while ago, and we get in slowly, but we're still way up on this stock if you've been following the rules. Alarum is down 93%. I don't even remember why. Gatekeeper minus 53. How am I always getting in at the wrong time? Steve, learn the lessons, bro. Like, you should have been out of Alarum a long time ago because I got out of Alarum. First rule, like, if you're not making money, if you're losing money, you should default to the original rule, which is buy at the price I buy it and sell at the price I sell at. And don't do anything else. If I pick a stock at 5 and it goes up to 6 before you can buy any, don't buy any. Because I bought it 5, and now the stock is 6. So you don't buy any unless it pulls back to 5. If you missed Isaiah, right, when I picked it back here at whatever it was, maybe 350, let's say, now you have a chance to buy it at 350. But if you jumped on it at 582 and you're down, guess what? That's because you broke the rule. And you have to learn the basics first. The basic level would be buy at the price I buy and sell at the price I sell at, and you'll be fine, right? You'll get the same, performance that I get. I'm not encouraging that because I don't want like the SEC to think that I'm telling people to buy my stocks. But that's the basics of how to get the feel for these things. And then you can like paper trade. So you know what? Maybe I should sell some here or whatever, but I'm not going to do it because I'm sticking to those basics. Learn how to do the basics first, and then you should get the same profits that I get in my spreadsheet, right? How will you not? P.S. Too old to take notes. Then I shouldn't have even answered the question if you're too old to take notes. If you're too old to take notes, you're too old to make money. Thoughts on cybersecurity? Ask me next week and put 3 question marks in front of it. Follow the instructions. If you can't follow simple instructions, you can't make millions on the stock market. What are your thoughts on the AI round trip revenue loop? Ask me next week. That is one of the things I was going to talk about here. It's not as bad as you think. A lot of people are making it sound bad, but there are some interesting things there, because if Nvidia gives a company $1 million of an investment, and that company turns around and buys $1 million worth of Nvidia chips, that comes back to Nvidia in terms of profitability, and they trade at a 12x revenue multiple. So Nvidia's revenue, Nvidia's market cap benefits 12x whatever revenue comes back to them from those investments. That's not necessarily bad, though, and I'll explain that next week. Didn't have time this week. It's not a lightning round type question. Curie chart. Now we're really going lightning round because it's 3:55 and I like to sign off by 3:55 so we could just close the market without yapping. Let's see. Newbie question, but does it matter if you sell shares with the loss or the gain in a Roth account, so no tax implications? Yeah, I mean, I like to, if I can, favor the Roth account, but it's hard to know when a stock's going to go up or down. So how do you know when to take profits in a Roth account versus another account, right? What I will tend to do is, if I'm going to sell a chunk of shares, maybe I'll do it equally in each account and I sell in the Roth first, because if I'm selling, then the stock might be going down because of my selling. So you want that Roth profit before you get the taxable profit. Hope that makes sense. If not, ask again next week, earlier in the show, before we get to the lightning round. Evolve chart. There's your evolve chart. Doesn't look great to me, but I think they had a great quarter. So it's weird. I will be playing the quarter on this one. I don't always do that, but I will this time. Because of the confluence of factors, data points that I have at my disposal. Can you give us an estimation of what you think the timeline will be of the AI build-up? I have no idea. It is way too soon. Let's put it that way. We are not close. We are not close to the end of the AI build-up. And I told you before, put it in your notebook. I said, follow the money. Follow the CapEx spending. CapEx, when Google and Meta and all them, when they report, they tell you, they give you CapEx guidance. That CapEx guidance is still growing. Every time they tell us what their CapEx will be, the number is higher than last time. Okay? I have some data on that somewhere, but I don't have it on me here right now. But CapEx keeps growing. As long as the CapEx guidance keeps rising, if it flattens out, okay, that's the first sign that there might be a problem. If it flattens out, but it's still rising, we have plenty of time. What about TSSI? What about it, bro? You've been watching my show a long time, enough to not ask that question. We already talked about it anyways. What do you like about AOI aside from the technicals? Nothing right now. Okay, because the product that they produce is, I think there are delays. I think there's going to be delays in the adoption of their technology, but that's widely known out there and part of the reason why the stock has come down. So, while I like the technicals and I'd be tempted to buy a little bit of shares down here because it's been cut in half, down 60%. Right? Now we got something here. Chasing it at 150, 175, 200, 200 plus didn't make any sense. And look, we got up to the top of this line. There you go. You get what you pay for. And this is a large cap stock. So I don't want to take big chances on this. I want to be sure that we're done with this route in the Qs. If the Qs get down to the 200-day moving average. This is what I would love to see. I would actually love the Qs to get back down to the 200-day moving average, which is here. It also happens to be where the red line is, so it'd be a double support level as part of this bubblicious market. And simultaneously, we see fear and greed get down to 25. If we get those three things happen, write it down. I'm going to be really interested in buying AOI because this company's got a lot of juice to it. This is a stock that could go to 200 again in a blink. That's double your money. QQQ is not going to double. But if QQQ jumps 10 or 15% from here, we might see that. We might see AAOI double if the Qs go up 10 or 20%. But we got to see the Qs to feel more comfortable about that happening. I would want to see the Qs drop further down. If it doesn't happen, if the Qs bounce from here and keeps going up, I have enough stocks. I'm going to make money. You saw I was buying stocks on this show live right here. I'll make money. I don't need to take a chance, roll the dice on AAOI at 100 when the Qs are still way up here. I'm looking for the juicy fat pitch. And if the juicy fat pitch doesn't come, I'm not swinging the bat. Period. Okay? I'm not afraid of losing out. There's no FOMO here. FOMO will get you effed. That's the F in FOMO to me. Okay? Discipline. It's domo. The discipline's going to make you the money. Domo gets you modo. Finishing off the show. Iron chart. Oh, this has been ugly. I'm in this one too. I've been losing money on this one. Okay. We can't, I mean, it's the lightning round, so we could talk more about it next week if you ask a question about it earlier. And if I have something new to say, which I might. Actually, I'll write down iron. I think I do have some things to say about iron, and we'll talk about it next week. What do we got left? Is a company like Marvell and AMD expensive or not right now? I mean, bro, see, if you're asking the question, then you shouldn't even think about it because you don't know if I'm one of the 10,000 clowns. But there's your Marvell chart. I'm interested in Marvell here. 200-day moving average. And if it's a large stock, it's not easy to triple your money on a stock this big. And look at the long-term chart. Okay? Look at this. Does this look like a company that you want to invest in? And you see what happened? My white lines, of course, are preliminary green lines. Right? So this could easily be the red line. That means it busted above the red line. That means no, too expensive. And what did it do? It came all the way back down. The gravitational pull pulled Marvell back down to money marks line. I don't want to buy it here at this line. It's still expensive to me. And you should know that. If you don't know that by looking at this chart, all you have to do is ask, Marvell chart, please. And you should be able to answer this question. If you can't, it's because you haven't learned the lessons. You haven't I guarantee you haven't listened to this, read this, and watched this. And if you can't do that for yourself, then you can't expect me to hold your hand and give you a fish. I'm teaching you how to fish. Put the pole in the water. What do you think will happen to Oracle if QQQ goes to the 200-day moving average? Who knows? I'm not God to know. I'll tell you what, though. It's crashed to the 200-day moving average. It's moving. And see, look, it's still only in the middle of my risk-reward range. I told you to short. This is a rare time. I told you to short a stock. I told you to short Oracle here. That was, I mean, wow. I didn't expect all this. I've been covered a long time ago, but I mean, I told you to short Oracle. It was 333, and now it's like it's down like 67%. That's amazing. That's what happens when you actually know what you're doing. Okay? I'm not always right, but most of the time you're going to be. Most of the time I'm going to be right on these things because that's what I did for a living. That's what got me retired at age 38. You know what I'm saying? I've been retired for, 18 years. Jesus Christ. Almost 18 years. Is it positive or negative on iron? Stay tuned. We're done. There's no more question mark, question mark, question mark. And by the way, you didn't question mark, question mark, question. You're new. I've never seen your name before. So job, bed, however you pronounce that, 9459. Welcome to the show. Welcome to the show. Get used to my language, right? Coach A-hole shows up once in a while. It's because I love you. That tough love, that's what's going to make you a millionaire because you need the discipline. This is Sparta. And this is Friday. And this is Money Mark Stock Talk Live. Have a great weekend. We'll see you next week. Come back for that. If you want to listen to the show, we now have a podcast. We'll see. It's supposed to automatically form and all that. We'll see if that happens over the weekend. If not, somebody hit me up and I'll see if I can figure it out. The first one was a couple weeks ago. It's already up there. It's Money Mark Stock Talk Live podcast on Spotify, on Apple Podcasts. I promised I wouldn't have any advertisements, and I'm advertising myself. I guess that doesn't count, right? See you later. Have a great weekend. I'm going to finish my beer and then think about having some dinner or just go to bed. Liquid lunch, liquid dinner. Night, night. Mm. Mm. How do we do today? Looks like we did okay. Not a bad day. Could have been better. I think some people are speculating on some stuff. You sneaky bastards out there. I'm just gonna surprise you with it. I'm not gonna let you just take money from me, make money off of me like that. We make honest money here. I can't make money like that. You're not gonna jump on my names just for a quick profit. Most of you have no idea what I'm talking about, but that's what this outro is all about. The show's already over. The rest of this is just a bonus. Me just ranting like a lunatic because I have a whole 23 ounces of beer in me. I got to drink the last ounce of this stuff. What else we got? Okay, so not a bad day. Not a bad day. Check these last messages. 11 p.m. Everybody's asleep here. I'm next.